Welcome, everybody. Thank you for joining us on our wine exploration, investment exploration tour with a bit of a wine theme to it, joining Robert and myself as your hosts with Parvis. So today we're looking at Capital and Cabernet, exploring commercial and industrial real estate. In the past, we've looked at a lot of different types of residential real estate, but today we're bringing a different flavor to the table, a flavor that a lot of people typically don't get exposure to and often miss and don't actually know it's out there or accessible to them. A space that, unlike the stock market, is the exciting part about industrial and commercial real estate is that your money keeps going up without all of the craziness of a roller coaster. So you can get excited about your money growing in a steady pace. In things that people use on a very, very regular basis for everything that they're doing. So for those of you that are new to our series, Parvis, we are an exempt market dealer. But first, our disclaimer. This content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offer to sell or solicit of an offer to buy any securities. We will do that later on, one-on-one with everybody involved as investors. So who is Parvis? Parvis, we are publicly traded. We are on the stock market. We are a technology-driven real estate investing platform and exempt market dealer. So we bring institutional quality investment opportunities to eligible and accredited investors across Canada and soon the United States. We try to make the process as seamless as possible because there sometimes can be a little bit of friction in the past, lots of paperwork. We make it a lot more easy for you to read through everything and make sure it's actually easy to run through. So for more information on that, you can definitely come visit our website at parvisinvest.com. Typically, we look at all kinds of different investment opportunities, primarily in the real estate arena, but we do venture out into other business assets as well, which can become quite lucrative over time when you have a very well-diversified private equity portfolio. So why are we doing this? We're basically expanding investor access to premier exempt market investments. Because in the past, it was what we like to call the Wild West or the country club of investments, where typically you only had a very small subset of investors that actually had access to these types of investments. So exempt market dealers such as Parvis, we're trying to bring that to the more open market, so it is more accessible to regular investors like yourselves and us. So what do? We broaden access to a wide range of investment assets. We take care of all of the legal and compliance adherence to make sure that everything that we do bring to the table follows all the rules and regulations as set forth by regulators. So we ensure that investments that are coming on board that you want to get involved with meet all those legal criteria, and so we have several hurdles of safety for you as investors. We also look through your investor profile, and that way we can help customize some portfolio strategies for you. We are also in the process of building what we'd like to call a secondary market space. So for a handful of issuers, those that qualify, we can actually put in place a secondary market space for liquidity reasons. If, say, for example, you are in a soft lock where your term is 5 years, but you need to get out a little bit earlier due to unforeseen circumstances, there is possibilities there eventually for another investor to take on your position and help you to liquidate. And then because we're fully online, we have a lot of cost efficiencies and full transparency as we are a publicly traded company. So we basically have to be really, really transparent about everything that we do. At any time, feel free to go visit our ticker symbol. It has been doing quite well, actually, the last few days. I'm very happy about that. And I'm sure a lot of my investors that have invested in the company itself are quite pleased with that. Our platform itself is quite seamless. You can access it either through PC or through a tablet, and to a certain extent the phone. But we try and make the investment process as streamlined as possible. So you go online, look at the various assets you can invest into. And then after that, you have a conversation with your dealing representative. So either Robert Blake, who's joining me this evening, but we also have another Robert on the line, Mr. Lefebvre. Then there's myself, and we have several other colleagues that can help you if they've invited you to this session or any other session. We're happy to help you get involved. All right, that being said, at the end of the evening, there will be a raffle for three lucky attendees. Don't forget about that. You do have to stay till the very end to qualify. and we will be sending out some lovely vintage wines out to every winner within the following week. I just have to arrange for that. And that being said, this is the most expensive slide of our deck, the legal disclaimer slide. I won't read through this, but it's in essence a legal disclaimer that no one actually reads, but is probably pretty important to do so. That being said, we have three great issuers today presenting for you. So we have Forum Make Space, which actually Dennis and Danny are presenting. They are going to make it fun. It's one of those things that everyone uses and is out there, but typically is not very exciting. Followed by, we have Dominic with Invest Plus REIT in the industrial side. The industrial arena is pretty interesting. Large scale buildings with lots of industry inside, long-term tenants, and there's a couple of extra tidbits in there that Dominic will share that make that particular type of investment pretty enticing. And then finally, we have Julianne from Revesco on the retail side. And if you've been keeping attention to the marketplace out there, although residential real estate is slowing down, turns out retail is picking up some steam. So something you'll probably want to really take a deep dive into. So that being said, I will pass it on to Dennis to get us rolling. And presenters, you each have approximately 15 minutes. I'll warn you when you're at the 5-minute mark, and then we'll go from there. And then feel free, everyone, there is a chat box. When you have questions, please put some your questions in the chat, and we'll answer them as we go. Any questions that we don't have time to answer, we'll get answers to you through email or time permitting nearer to the end of the presentation. So take it away, Dennis.
Okay, thank you, Mike. Thanks, Robert. Thanks, everyone at Parvis. My name is Dennis Hedinger. I'm executive director of a firm called Forum Make Space. We want to. You all have experience in self-storage. You all have noticed them as you drive around. I always use the analogy. I'm a new dad, and so we're a Volvo family now. And I never saw Volvos anywhere. Now that we own a Volvo, I see them everywhere. I think it's going to be the same for MakeSpace, no matter where you live, be it BC, Alberta, Ontario, Quebec, whatever it may be. You'll start noticing MakeSpaces around, and this is a way for you to be a direct owner in those self-storage facilities. I'm going to pass it off to someone smarter than me here after this slide, but I just wanted to give you an overview of who we are, as you probably never heard of Forum MakeSpace from a hole in the wall. And so we're a proud Canadian firm, been around almost 30 years. And we focus in alternative styles of real estate. So something very different than conventional multifamily or conventional office real estate. One of the things that we do is self-storage. And so we have almost 65 self-storage facilities across Canada. That makes us the 5th largest developer, owner, and operator of self-storage in Canada. And we're one of the fastest growing as well. So with that, I'd like to bring on Danny Friedman, who's the CEO of MakeSpace, a great partner of ours, and someone who has lived and breathed this business for 16 years now, right, Danny? So I will throw it over to you to give a lay of the land of the exciting, sexy world of Canadian self-storage.
It couldn't be sexier. Thanks, Dennis. Appreciate it. 15 minutes is going to be a really abridged version. Robert, Mike, thank you for, having us on here to share our story. Obviously, there's going to be so much more to the story than what I can share here today. Obviously, everybody's super excited about self-storage. Nothing more exciting than that. I'm excited, and that's because we're continuing to grow. When I first started in this business or with this fund in 2018, we had 2 self-storages, one in a small community on the west coast called Pender Harbor, one in Winnipeg, and we've grown it year after year to over 33 storages in this fund now. We have over 1,000 Canadian investors in this fund, and it continues to grow every year. So, and excited to give the opportunity to Canadians to invest in one of just a very stable, growing industry, and we've become one of the top players in Canada. Just to set the stage very quickly for why storage, what's the story behind storage, and what's the advantage now? I think most people know storage. So you typically have some life event that happens to you You need storage. You go in there, you think you're going to store it for a month, 2 months, 3 months. And literally in every presentation I've ever done, I've asked someone, how long do you actually think people stay? Well, they're like, they go in for 2 months and they stay for 3 years. And that's really the storage business. Once you start using it, you see the value and maintain your stuff in there. And it's only happening more and more. Like, first of all, on the supply side, construction costs are so high now to build new self-storage. There's barely any new storages being built in Canada. There's about 3,500 storages in Canada, but that really only represents about 3 square feet per capita. Whereas in the States, they're closer to 8 square feet per capita in terms of storage supply. But it's so expensive that it's tough to pencil it out. There's really very few growing. And on the demand side, in Canada, we're just building different types of residences now. We've already had the population growth. We've already got lots more people than we had. But, when you look at example, a small community like mine, I live in Gibsons, BC. It's a town of 6,000 people just outside of Vancouver. You would think we have lots of space and we're building these, small community, we'd build these single family houses, but we're not. We're building duplexes and condos and triplexes. And that's going on across Canada. Over 80% of new housing starts in Canada now are multifamily. And so what that means is there's no second bedroom. There's no basement. There's no garage or a smaller garage. And so more and more, we believe over time, and these are long-term tailwinds, which is what we believe in, there's going to be more and more need for storage in Canada. So demand growing and supply constraining. And that's really the story that we have. And that's what we've seen. That's what I've seen over the last, call it 8 years that we've been running this fund, or 16 years, as Dennis has said, that I've been in self-storage. And then the last piece is, can we go out in the market and can we buy storages and make them more profitable than our buying value? That's sort of the business that we have. And, our argument is yes, and we have been able to do that. But just to give you a sense of the market, in the US, you have the top 10 owners of storage are all public REITs, and they own about 50% of the market. In Canada, the top 10 owners only own about 20% of the market. So really only in the second or third inning of consolidation. And there's nobody else in the markets that we're in that's really consolidating the businesses right now. So we're not looking to boil the ocean. We're not buying all the storages in Canada. There's about 3,500 storages in Canada, maybe 700 that we think will fit for our fund. But we're only really looking to pick up 6 or 7 storages a year. And that's all we really have to do to grow it. So I'm not going to go too far into like why storage. I will say that it's not cyclical. It doesn't matter on the demands for storage are life events. It doesn't matter, the economy. There's always some demand for storage, and our job is to take the people in those sort of stressful situations and really bring them into our storage, give them some comfort, and show them the space where they can deal with this low aspect of what's going on in their life. You can see here over the last 35 years, I like to say there's never really been a bad time to invest in storage. Really solid returns, which is what this is saying, and then really low standard of deviation. So we're not really going up and down like a stock market or other investments. It's a steady rise of storage, and that's what we've seen really since 1994. Our thesis is we do not build 6-story storages in downtown Toronto, Vancouver, Montreal. That's a business in storage. There's some people who do that. That's not our business. Our business is secondary and tertiary markets. We go into, like, if you're driving across on vacation, you're driving across Canada and you go past a small community and you see a few storages on the outside of the community. You probably think, oh, that person's making money. And they are, and those are the type of businesses that we buy. And we buy them because we can buy them at a better dollar. They usually come with a little bit of extra land, so we can add value to the storage, and we can run it professionally. Which, we can add the same technology that the billion-dollar REITs are adding in the US, and sometimes we're actually developing our own technology that's even better, which is super exciting. And we're just able to drive the returns that are needed. Well, first of all, it drives value for the customer locally, and then drives demand for the storage. Then that builds occupancy, and once the occupancy is full, we can start appreciating rates to match the demand, and that drives results for the investor. And that's what we've been able to do over and over and over again with our facilities. Again, I'm going through it kind of fast. We got 33 properties across Canada, from Quebec to Victoria Island. We target a 10 to 15% return. We've never missed that target. To over 250 million in AUM now. Like I said, we started in 2018 with 2 storages. We put our own equity in, my partner and I, and we said, join us. We're going to buy and run these storage as well, and build returns over the next, however, indefinitely in the future. And so far, we've been able to do about 11% return a year. And our value add strategy is, the typical storage strategy is appreciate rates, control expenses. We also add layers of like adding units, exterior lockers to a facility. We'll add portables in the market. We'll add parking. There's lots of different tools in our belt to reach the returns that we want to reach. Some kind of good map of Canada gives you a sense of where we're at across the country. Heavily weighted in Vancouver, in BC and Ontario. I love this page because it's kind of like this is the typical facilities that we own. Again, sort of shows the weighting across Canada. And again, not the Taj Mahal facilities, but nice, clean, good facilities that the local markets need. The one thing I will say about MakeSpace, so Forum is our investment arm. MakeSpace, we're true operators. Everything is in-house, from our own proprietary pipeline, our own software that has all 3,500 storages in it. We do off-market deals. So our acquisition team is all in-house. Our call center is all in-house. We do all of our financing in-house. We run the fund in-house, and we run the operations in-house. So everything in the company is done by us, and I think we're one of the best in Canada. I put my team up against any in Canada. This is just to give a snapshot right now where we're seeing the opportunities in the market. We probably underwrote 70 or so storages this year. We're always in the market looking. We've got, I think we did 6 so far this year, or 5 so far this year, and we're looking to add another 4 to 6 by the end of the year. This is a good example. Prince George, we bought it in 2020 for 14.3 million. This is the type of work that we do. We had a piece of land and 2 pretty high occupancy self-storages. With 2 high occupancy, we sort of appreciate rates on a micro unit basis. So if 5x5 comes up, we look at the demand for that 5x5 and we appreciate the rate by 5-10%, and sort of grow the revenues of the storages that way. With the piece of land, put 10,000 square feet of new storage on it. We actually, during the pandemic, wanted to build another 25,000 square feet because storage really boomed, but the city literally closed down. We couldn't get a building permit. So we took 100 shipping containers and put them on the site and filled them all up. And then we built another 25,000 square feet. And then there was still demand. We bought the land next door, took our portable fleet, put it on that land so that we got better financing, and added more on-site containers to that area. And between all of that, it's about $2.5 million investment over that time. So about $18 million in investment. We've appreciated the value based just on NOI, not cap rate compression, no financial engineering, just based on our growth in our NOI to $33 million in value. I think it's exceptional work, and it's a good example of exactly what we do. This sort of shows our returns over time. And this is the last couple of years. We've been about 11%. This is the team behind Forum and MakeSpace. Again, we're Canada's largest self-storage. This is the team focusing on self-storage right now. These are the independent trustees that look after the investors in the fund. And I think that's it. Anything you want me to add there, Dennis?
No, I think you did a good job. Just maybe real time. Those 6 Ds of self storage are pretty depressing, right? There you're talking about death, disaster, divorce, all of which are increasing pretty exponentially in Canada. Maybe just touch on the level of discussions we have within the firm about treating people with empathy as we solve to these, what could be pretty negative life events when they come into contact with us.
Yeah, like I said, like people usually come in stressed. Like if you think about the times that you may have gone to look for storage, you're moving, even just moving. Like it's so stressful, that day of moving and like you're trying to get things done and like emptying your house, and like maybe you're dealing with someone who's passed on and you're like dealing with all of their stuff and trying to figure out like, what do I keep? What do I give away? These are just stressful times. So our team is trained to, as you come in, like, you're dealing with someone who's stressed. How can we bring them in? Well, how can we make this an easy process for them? Make this the thing that they go away saying, you know, I dealt with MakeSpace, it was a good experience, and you know, they pass it on to their friends as well. So
Well, and on
that's sort
that,
of
Danny, maybe there's a baby boomer wealth transfer that's happening that's been in the news for years, but there's also a baby boomer stuff transfer that's going to occur, right? You
totally.
guys think about it logically. You don't want to have a parent die. You're not going to go throw away all their stuff tomorrow, right? You may not want to use that fine china that they've held on to for 40 years, but you're not going to go throw it in the trash either, right? That has to go
Exactly.
somewhere.
Yeah.
And so, we're in a
Well,
unique position to benefit from that transfer. Is that correct?
yeah, and the story, you know, that I read, I think it was about a month ago, it was like someone who had like a 4-bedroom house that then they passed away. Well, their kids only had like a condo. You know, like how they can, where are they going to put all that stuff? You know, you can't see, there's nowhere to go, right? So that's a great example of the type of demand that we see only increasing over time. Somebody
Danny,
asked about the loan value. I just want to
yes.
speak to that. So the
Yeah.
loan value of the portfolio right
Yeah.
now is about 55%. We actually used to finance each individual storage. We're now in 3 portfolio fixed rate loans that expire in 28, 29, and 30. So they're sort of laddered. So we get a little bit more liquidity within the storages. Like cash used to get caught at the storage because of the DSR, but now it can be used within the portfolio. So anyway, more liquidity for us to invest in more storage.
Excellent.
And Danny, a comment on do you use fixed financing or variable financing or a combination of the two?
No, it's fixed rate. Like we're not playing in the market. We're not looking, that's not our business. We're not looking to financial engineer or make, you know, guesses as to whether rates go up or down. We make pro formas based on the rates that exist right now. Look, I set a clock for myself at 15 minutes. That's what you heard there.
Beautiful.
Beautiful. Like it. All right. Well, we don't have any other questions right now, but I did have a poll running in the background while we were chit-chatting, and it seems that it's a 50-50 draw between who uses self-storage and who doesn't. I know I've used it in the past when transitioning between homes, and it's yeah, they're great to have.
My favorite story is when I used self-storage. We staged our house before we moved, and that's one of the sort of reasons that you go in. And I had nothing to do with self-storage at the time. This was a long time ago, but I remember going into storage, and the lady, as soon as she cashed my sale, the computer went cha-ching, and that was what the owner had.
Wow. And Danny, maybe you could end on, I don't know if it's going to shatter people's dreams by opening the kimono, but you did have some dealings with storage wars, correct?
Do we do storage wars? We're actually doing a storage war. We're doing a charitable auction coming up this weekend where we fill the container full of a bunch of different things and auctioning it off for a local charity, for a local food bank. So more on that later, but we're excited to one of our staff is actually running the charity, the auction, which should be fun.
Wow,
fantastic!
Yeah, send us the details, and we'll share with all the guests on our follow-up email.
Cool,
absolutely. Yep. Excellent. All right. Well, we don't have any more questions for now, so I guess we'll move on along to Julianne. I guess you're next.
Yeah, Michael, Robert, thank you for having me. Yes, this is also my most expensive slide in our decks. Revesco was established 14 years ago, and it was started by 4 partners that went to university together, graduated from UBC in 1995. 2 of whom went into business together right away, and then they came back together 14 years ago. But what they do is they buy retail, we buy open air retail centers in the United States. So before you get excited about hearing investing in the United States, hold on, I promise it's really simple. So we're buying US assets, but we're buying them with through a Canadian mutual fund trust. That's the investment vehicle. That means that you're getting access to US real estate without having to file a US tax return. And not just any US real estate that is income producing day one. So when we're underwriting these properties, we only will even look at bidding on something if it's delivering our distribution. So it has to be hitting 7% cash on day one. So we're trying to mitigate that risk right up front. Why do we do this in US and not in Canada? Much like Danny was just talking about how what the weight of ownership is in Canada versus the US. It's reversed when it comes to retail. In Canada, I can fit every owner of retail around an 8-person table. It is so institutionalized, and there's very few centers that trade. Not to mention that it's a smaller market. The other thing, when it comes down to it, is that the US economy is driven by the consumer. And regardless of where we are in a cycle, the consumer stays strong. 70% on average is what the 70% of the US GDP is the consumer. So they're going to keep spending regardless of what happens. But I want you to think about what you do every day, because that's where we come in. That's what we buy. So what we're buying is, we're not looking at buying an enclosed mall. Never. This is open air. We're buying real estate that's based on habits. So let's talk about what you did this week. Did you get coffee? Retail. Did you pick up your dry cleaning? I forgot. Childcare, perhaps. That's retail. Your gym? Retail. Groceries? Also retail. Pharmacy? Retail. Getting a haircut? Can't order that online. You're picking up takeout. That's retail. So what I'm trying to get at is that we touch retail so much more than we realize, even as Canadians. The stats are something around, an average Canadian touches retail one time a day on average. The average American is 7 to 8 times. I might even have a slide on that. All that to say, there is a lot of noise right now. And guys, I get it. I'm a Canadian. We're a Canadian company from 4 Canadian partners. There's a lot going on. There's war, there's geopolitical tensions, there's Trump, there's everything you could imagine facing against the US. And yet I was just in Denver last week, and one of my colleagues has been on the call, and nothing's really changing for people. So we get these clickbait headlines, which is their job, to tell us that the consumer sentiment is at its lowest it's ever been. Cool. That's fair. I can be angry that gas is $2.10 a liter, but I'm still going to fill up my gas tank because I need to get my kids where they need to go. So it's cautious, but it's not collapsing. It's just shifting. People don't give up necessity and routines first. They give up luxury items. And then we're going to layer on just the macroeconomics of the sector. So when I started with Revesco about 4 years ago, I came from multifamily in the US. And I was a little bit, had all the questions. What about Amazon? What about, all these stores closing? Here's the thing. We call retail, unfortunately, it has been the redheaded stepchild of commercial real estate. And over the last few years, what we've seen is vacancy that is the lowest it's been in 30 years. Asking rents are increasing, and e-commerce, meaning anything that you buy online, is actually leveled out to about 16% of total sales. So that's a lot of people still wanting to go and feel and touch and pick up what they want. I don't know if anybody's ever ordered food from Instacart, like had somebody else grocery shop for you. It's the most painful experience ever. So there's a lot of things people still want to do every day and that you can't replace with online shopping. And this is my favorite chart ever because I love how it shows the history of retail. So this chart is going back all the way to 2001. So we're looking at 25 years. So we've got the bright blue line here that you're following. That's the vacancy rate. You can see we've noted things like the tech bubble, the great financial crisis, COVID, and how rents have behaved. And then top that off with what's happening with vacancy and the gross effective rent. And most importantly, and this is where supply and demand comes in, supply growth. Much like Danny was saying, and I'm sure Dominic will say in his presentation, development is so hard right now, not just to find the space, but then to buy, to command the rents that you would need to. So, we're buying below replacement value at about 50 to 60% of replacement value. So you've got a lot of room to move rents up to market. And a lot of these types of retailers that we're dealing with, they're the off-price retailers. They're the winners. They're the Dollar Generals, the ones that do really well in any market. They're looking for a less expensive rent so they can keep their prices strong. And then the other piece is just kind of the cherry on top that I'm excited to say that we are well down the path with is institutional capital. So over the last 24 months, 18 to 24 months, over $10 billion of institutional capital has been taken out of other real estate sectors and put into particularly open air retail. We are down the line about 6 months into a deal with a large institution out of New York, looking to put a significant amount of capital into our platform, upwards of $200 million. So we are really primed right now. There's a lot of good things happening to us to take advantage of what's happening in the market right now, both on the buy and on the sale side. There's a lot out there that we can still find good deals on, but that window's going to close. So that's why we're really pushing to get this capital in now, because we're going to be able to find the best deals. The story of these guys, I got to tell you, I'll bring them on once because they're just such real estate nerds, for lack of a better word. So Chris and Scott, you've probably never heard their names. Chris Wood and Scott Lee, you've probably never heard them, but I would be surprised if you haven't set foot in a store that they have opened. They started a brokerage focused on bringing U.S. retailers to Canada back in 1996. Their very first mandate was Costco. So Chris and Scott have found the space for every Costco, every TJ Maxx, which is Winners, Marshalls, HomeSense. They did Target, Walmart, Lowe's, PetSmart, you name it. You can see it on the slide here, and there's about 70 other ones. So what that has given them is a very, very deep Rolodex of retail relationships, meaning if we're going to go buy a center that maybe is anchored by a Costco, we're not buying the Costco, but we want to make sure that Costco sticks around, or that Target, or that Marshalls. Whatever that anchor is, we want to know they're really strong. So we have an in that gives us an extra layer of comfort when we're underwriting these deals. The fund has been around for about 5 years, although Revesco's been around doing this much longer, just with GP-LP deals. But we wanted to be able to bring it, like Michael was saying earlier, to the broader public, to groups that wouldn't be able to come in as accredited investors and write a $500,000 check to get into these deals, which is really exciting. And prior to the fund, over 12 exits, they had realized on average 19.5% annualized returns to investors across those sales. So we're targeting about 12 to 15% for the fund. We're comfortable within those metrics. And one thing I always really want people to understand, because it is so different than what you're seeing in apartments, which is what a lot of people are used to, is that the value add really does take time. We're buying in, the first thing is we're never buying a problem. We're buying in markets that can sustain a cycle. So we're not looking at low income. This is annual household incomes over 100K, dense population, and a highly educated population. Because that's one thing we found, is that the higher educated a 3-mile radius is, the better their earning potential is, and the more kind of free cash they have to spend. Those are all good for retail. Once we buy them, we're creating value. We're leasing vacant space, which is really where Chris and Scott excel. We're restructuring leases to make sure that there's incremental rent bumps of 3% every year to, fight that inflation. We're improving the tenant mix, and I'm going to really quickly take you through an example of that. And then we could also have the opportunity often to increase density. So think of where you grocery shop. There might be a Loblaws and a Shoppers Drug Mart and a liquor store and a bank, but then there'll be the Starbucks drive-through. That's what we call a pad. So we can add pads, which we've done at a couple of our assets, and we either sell those off or we ground lease them to different groups. So there's a lot of different ways to make money in this sector. What are you buying into right now? So as I said, we are still fairly young. We've got $173 million assets under management. Our LTV across the fund is 57%. So very conservative and Canadian. And our weighted average lease term is 3.2 years. That's maybe a term you might not be familiar with. It's also, we call it WALT generally. And that means that in our current portfolio, we have guaranteed rent for the next 3.2 years, which makes it really nice because we know we're going to hit our distributions. We don't use, very much like MakeSpace again, we only use fixed rate debt. We want to know what is coming out every month, and that just gives us peace of mind. Why is our peace of mind important? Well, the partners actually have 10% of the entire equity in this fund. We are stewarding about 70 million, close to 70 million of investor capital right now, but 7 million of that US dollars, I'm talking in, 7 million of that belongs to the partners and us as a firm, as employees. So we're really well aligned for us to go forward and grow this thing and execute. And we're the only people that are doing this in Canada right now on a private side. There's Choice REITs and Canadian Tire REITs, but not accessing US and not accessing very specific sort of more niche opportunities. So this is Aspen Place, which I wanted to show you because it is really our flagship asset, and we are going to be going to market with it this year. We've been averaging 9% to our Series F investors, which is our, first round, our zero fee fund over the years. And that's without selling anything. And really with any real estate investment, the big pop is on the sale. So Aspen is really a great story. We've owned it for 4 years. We initially bought, and I'll just bring up the site plan here. We initially bought everything except for this Whole Foods, and we got out a bunch of random tenants. We've now brought in Anthropology, we bought in Free People, Carhartt, Lululemon, Sephora. We just signed a lease. That's that LOI and number 200 there, that big space. So we're changing out the tenant mix, which means that the next group that buys it has a core asset that is just spitting them out, 8 or 9% cash on cash, and it's good to go. But where the magic really happened with this asset was how well these guys know retail. This Whole Foods was owned by a doctor that lived in Utah. This is in Flagstaff, Arizona. And we actually took us almost 3 years to pry the Whole Foods loose from him. And finally, his back was kind of up against a wall. Much like many people in 2002, 2003 were feeling by signing these really cheap loans. His mortgage was up for refinancing, and all of a sudden the value of his property was not where he thought it was. So he would have had to pay to refinance that loan. We were able to pop in, get it for about $2 million less than we had offered him. This is in 24, $2 million less than what we offered him a couple years before. So all that to say is what we did is we bought this Whole Foods. Now This is a grocery anchored center, which makes it much more attractive to a buyer. And our base pricing for this, so for the whole center, we've spent $41.2 million on it for the entire deal. And we recently had a bank appraise it at 56 million. So we are ready to go to market with this deal. That will obviously reflect a NAV coming up. We also are working through about 80,000 square feet of vacancy. We've got 17,000 square feet left. Our NAV doesn't move until those rents commence. And in retail, it's a much longer process. We're not putting some floors and some new tiles into one apartment and renting it for $100 more, right? We're working with major retailers like Ross, like Sephora, like Whole Foods. These deals take a year to get signed and a whole year to open. So you have to be patient, but we're going to pay you to wait. We're going to pay you 60 cents US a year per unit. And, really, I always think of this as a set it and forget it. Retail is the belle of the ball right now, US retail in particular. And what I'm really excited about is taking this institutional capital that we've worked really hard to bring in, put it beside our investors and our capital, and grow this fund to $1 billion in the next 5 years, which is the plan, or that's what they've hired me to do. So I'm just going to recap because I think I'm out of time. We're cash flowing from day one. We have very well real risk adjusted returns. And don't forget that 10% equity position that the partners have really aligns our interests. I'll let the guys go into any other details, but if there's any questions, I'm always happy to answer.
I heard a NAV bump in there, Julianne.
You did.
I'm pretty sure I heard it too.
Yeah, that's what us and
did.
greedy investors want. Yes.
Yeah.
Congratulations.
Well, like I said, when we had our conversation the other day, Michael and Robert, we were talking through that. We'd had some major vacancies. We had a vacancy in Louisville. We thought it was going to take us 3 years to fill because it's 40,000 square feet. That was 6 months ago. We have an LOI moving to lease. It's going to be open in the next 12 months. Anytime we can move that faster, and the panic when Value City left, you feel like we have to write down this property by $2 million. That's what we did. We wrote it down by $2 million. That rent was $8 a square foot. The new rent's $12.50 a square foot, right? So not only do you replace it, you get market rents, and that's the win. But it's slow. Exactly. Really, it takes time. You're in here for 5 years. We're going to pay you to wait, or you drip it back in. But yeah, I'm stoked about where we're going.
Everybody have US dollars to invest as well, US and Canadian, your choice.
Yeah. Correct.
Low and steady wins the race.
Exactly.
Absolutely. All right.
Very good. Thank you.
I don't have any questions in the Q&A, but I'm sure I know a few people will probably likely ask me some questions later on for sure, and then I'll loop Julianne in onto another call.
Sounds good. And you guys, it's Booker. You guys, Julianne thing's got to end. It's Booker. Thanks.
Excellent. All right.
Now.
Oh, there we go. Now we have Dominic. Dominic was having a little bit of Wi-Fi issues, so we'll get that. Yeah. I'm glad that got sorted out. So we'll be able to. Oh, you're just on mute, Dominic.
Thank you, Robert and Michael, for having me on this event. Really excited to be here. I'm Dominic, the CEO of Invest Plus REIT. One of the things I'm going to talk to you about, the theme for tonight with a lot of the presenters here is talking about, whether, people getting excited about industrial. And usually, we get this conversation about industrial and they'll see the excitement, but usually the reaction is something more like this, where investors talk about, there's nothing really sexy about industrial real estate, But from my standpoint, when I look at this standpoint, what's great about real estate is that it shouldn't be sexy. It should be something that you can rely on, and over time see it go up consistently. In fact, many years ago, one of my earlier mentors always said is you want something that wants to make money while you sleep. And so, and that's, important to me. It's important to me that I don't want to have to be looking at how are my investments doing. I just want to ensure that whatever I'm buying is consistently growing and also providing the returns we set out to do over the course of the investment cycle. And so as a real estate trust, this provides you an opportunity to own a small share of an industrial portfolio. So all the buildings we're talking about today is you would have an ownership in all of those buildings and whatever else we acquire. So when you think about growth and you think about the ability to, it's not just one project going up or down, you are part of the company and now you become part owner. Now, one of the things that we're talking about today in the pictures that we're showing you today is just an example of some of the deals and some of the properties that are in the portfolio. But our focus in existing properties and existing real estate really takes out that risk that generally development has, which is getting your zoning, getting your permits, construction costs, and so on and so forth. But from our standpoint, we love buying existing buildings because there were some examples today that both Julianne and Danny talked about, is the cost to construct has gone through the roof. And that's done two things. It's one is, of course, is created this sort of demand that exists for industrial, it's created the supply that's sort of been capped. But you still have the same demand for industrial and warehousing and all that. And that's creating pressure on rents and creating pressure on values of properties. And so when we're looking at buying buildings, the first thing that we do, of course, is we look at the tenant base. And we focused heavily over the last 10 years to make sure that what we're acquiring, is going to be there. The tenants are going to be there for a long term. We've developed a system whereby the tenants now, once we have a building, we're looking to see how can we further that relationship, because a lot of these tenants have buildings or have real estate in other cities, and we want to be their pipeline or their landlord across all provinces. And so we're doing that on a consistent basis. And so when you look at from a theme is what is it that you do? Well, we really look for great tenants and put them in great buildings. And a lot of times we'll find the building with the tenant in them as well. And so some of the names that you see here are household names. Some of them are Fortune 500 companies, but most of these all have one sort of common theme is whenever they move into a building, they're likely going to stay there anywhere from 20 to 30 years or 40 years. And so those are the kind of tenants we're looking for and we're looking at developing relationships with. When we look at industrial, the one thing that attracts me the most is that the buildings that we're buying and the tenants that are in them are servicing what we call that sort of needs-based or essentials economy. If you think about all of the products that you use every day, for instance, right now we're streaming this on your computer, and that product was manufactured, was warehoused, and was delivered from a warehouse like this. And during recessionary periods, those goods still need to be made. And so warehousing space is still required. My history takes me from, I've been in real estate since 1999. We were primarily multifamily for a good number of years, the first 10 years of my career. And one of the things that really attracted me to industrial real estate is that in industrial, there's two rents. There's the rent, and then there's the operating rent. The operating rent covers your property taxes, insurance, and repair and maintenance. One of the struggles that we had when we had multifamily was keeping control costs on property taxes, insurance, and effectively repair and maintenance, because we as the landlord were on the hook for those costs. Not in industrial. In industrial, it's the tenant that looks after those costs. What that does is now it secures the rent that's actually pays us to pay our debt and to pay our unit holders. And then, of course, you combine that with a 5 or a 10-year lease, which is very common. Julianne touched a little bit on WALT, the weighted average lease term. Our weighted average lease term today is sitting around about 4.7 years. So for the next 4.7 years, we have effectively tenants or all of the income to be able to service our debt and also pay distributions to our unit holders. And then, of course, the asset has outperformed many commercial assets over the last 2 decades, specifically, with the 2008 financial crisis, the oil price wars of Alberta that we suffered over here, and of course COVID itself. And during COVID, we might have had an entire portfolio of 750,000 square feet, about 3,000 square feet of where a tenant was unsure whether they could pay, and we had to find a way to work with them. But we were very fortunate and still consistently paid out distributions to our unit holders. As a company, we're about $118 million of assets under management, comprised of 20 buildings. Of that, when you add up all of the lease space that we have, it's about 750,000 square feet. And of the 118 million, 43 of it is equity. So it's investors' equity, which brings our debt to value at about 63.5%. We're in 6 provinces across Alberta and Saskatchewan, and I'll touch a little bit as to why we're focused there right now. So as I mentioned before, my history started in 2004, where Invest Plus Properties was created, and we started the first 10 years in multifamily. And then in 2015, we created the REIT, and our only focus right now is in industrial real estate. We've paid over $13.8 million in quarterly distributions. Throughout that time, we celebrated our 44th consecutive quarter of paid distributions. And so we've only been able to do that because of the reliability in terms of, or at least the consistency that we've had in our portfolio and the long-term leases and industrial. One of the things that we do in great detail, of course, is we are always evaluating the portfolio to make sure that we're not overexposed in one industry over another. And so our focus is to try to diversify the industries that our tenants are in, because not all industries go up in value or go up in terms of the economy, and not all go down. And so as a result, we want to make sure that we're still focused in industrial real estate, but diversified from a standpoint of industry. And so leading with distribution, and distribution is primarily warehousing and delivering products to clients or to customers, or in some cases of our tenants, to their own branches, and then followed by energy, transportation, and manufacturing. And so this is something that we look at on a regular basis to make sure that we're not overexposed into one industry or another. So why are we so focused in Western Canada? Well, we did the research across the country, and we've been focused in Alberta and Saskatchewan now for quite some time. And the main reason is because these 2 provinces have what the world needs: fuel, fertilizer, and food. And so we have the 3rd largest oil reserves in the world. We have the largest reserves of potash. Not a lot of people know that, potash in the world. Potash is one of 4 ingredients in fertilizer. And then, of course, we export about $100 billion worth of agricultural products around the world. If you think about how countries today are working hard, including Canada, to secure minerals and precious metals, the majority of those resources are found in these 2 provinces. And what that does for us is, because we're focused there, that's where a lot of the jobs are going. That's where we're seeing the economic fundamentals are strong. The rates in terms of the returns that we're getting from the buildings are strong as well. And so when we look in the near to long-term future, Alberta and Saskatchewan are poised to lead the country, especially within the next year to 2 years. In terms of performance, if you look at our 5-year return, 9.21%, with our 3-year annual just a little bit slightly higher than that at 9.25. Last year, our return was 10.13 to the unit holders, and that's net of fees. And our target is always to get to that double-digit return between 9 and 13%. Our fund offering is our unit price right now is at $9, and you know, Robert mentioned it before about seeing a bump in NAV. Our actual Q2 published NAV that is set to be published here with all of our unit holders is going to be $9.29. So whoever buys in at $9 will see a 30-cent bump in their unit value. Our funds under management is 118 million with our target return at 9 to 13%. Of that 9 to 13%, 6% is paid out to the unit holders. One of the things that we love about also buying existing buildings is that we're able to pay the distributions. As our investors invest, they start collecting and earning distributions the following quarter. So because the portfolio exists, and so then the cash flow is there from operations. But one thing I want to point out is that the 6%, while not exciting to a lot of people, is also treated as return of capital. And Robert and Michael both tell you is return of capital is not taxed. And so when it's not taxed versus, say, an interest mortgage or a second mortgage and all that, 6% is almost equivalent to maybe like 9 to 11% that's taxed, right? So we also offer, for those who are not looking for cash, a dividend reinvestment program that pays an additional 3% of the distribution. It works out to about 6.2%, and it's compounded. It looks at the last quarter and pays the units based on the last quarter and compounded. We have RRSP eligibility. In fact, 40% of our unit holders don't even realize they can get into private real estate. And 40% of our unit holders are actually using their some form of registered funds. As long as it's registered, the trust can accept it. And then, of course, Olympia Trust and SGGG are our custodian and transfer agent who help us manage our business through the RRSPs and, of course, communicate with our clients in getting their quarterly statements. And we've made the minimum investment. We've actually dropped it from $25,000 to $10,000 this year, making it more accessible to investors across the country, and so we're excited about that. Like a lot of real estate trusts, one of the things we have to have is a board. But the point I wanted to make here is these individuals are your voice. They're there to make sure that we, management, follow through on the mandate of the trust. So anytime we buy a building, we sell a building, we get debt or refinance, we have to run this by the board. We meet a minimum of once a quarter, where it's looking more like 2 to 3 times a quarter, because there's a lot of activity and activity happening within the trust. But the other point I also wanted to make is that every single one, including myself, are fairly well invested. And so our interests are aligned very well with our unit holders. So we're all invested into the trust as well. So what I want to leave you with is why invest plus REIT. One of the strongest asset classes that has been strong over especially the last decade, and continues to be. And when you look into the future between the cost of construction and, of course, municipalities who are also slow to releasing land, that's just going to keep a lid on supply, which keeps vacancies low and rents high. A continued demand that we're continuing to see, that we've seen over the last several years. And of course, from our standpoint, given the team that we have, we lease all of our buildings internally. We have a couple of individuals who manage our buildings and also lease our buildings. We have some superstars, and that's been really the strength of our business. And we've never missed a distribution payment since inception. And of course, we like to think we had a strong performance over the last several years, with our 2025 return being at 10.13. And so to sum it all up, and let's get to the wine. Before I want to do that, I got one last slide. In the end, I want my business to be boring. I want it to be, I don't want it to be sexy, and I don't want it to be exciting. It should be slow and consistent. Michael said it, steady wins the race. And that's been our model. It's been my model, and it served us and our unit holders well. With that, thank you very much. Appreciate the opportunity. Thank you.
Excellent.
Thank you. Yeah. Well, one of the themes I come up with yourself, Dominic, and then also the self-storage and Julianne is rising inflation and how it impacts your business. And what's really interesting, I think, for our listeners and myself is to understand the fact that you're able to pass those rising taxes, maintenance, insurance costs. It doesn't impact the investor's return. That's being pushed off into your tenants. So that's a real inflation hedge and an advantage in this asset class that can't be understated.
Family size, and that still exists today. You have to be operationally, you have to be very, very good at it, but ultimately you also, in this particular case, not that we don't concern ourselves because we still want to be competitive, but how often can you contest your property taxes to drop them? They're going to consistently go up every year. And so when it's on the tenant's dollar, it doesn't really affect us.
That's very good. And then, sorry, I posted a question there. I know during your presentation, but do you buy a multi-tenant or do you just buy a building with one tenant?
We actually acquire both. Multi-tenanted buildings have the advantage of a lower risk, but also a lower return. The single tenant has the exact opposite. And so we have a blend of the two. We had this very discussion with the board, and our discussion was, should we include more multi-tenanted? And the reality is that when I first bought my first single tenanted building, the first, I had a few sleepless nights because I thought, geez, if that tenant leaves. And since then, of course, we have had a building where the tenant has left. But we have such a strong team to be able to mitigate that. We factor that in terms of our risk. But when you combine that with a strong tenant, I mentioned like Applied is one of our tenants, and they're in two of our buildings. And the president, when we were negotiating the lease terms on the second building, said, Dominic, any building we're looking into, we're looking to stay there for 25 years minimum, right? And generally they're more in like 40 years in these buildings, right? So we want to blend it and balance that with some multi-tenants. So we have a blend of the two.
Excellent. All right. Any more questions, Robert? I didn't see any other ones on because there was a drip one, but you answered that question with one of your slides there. So that answered that with the 3% bonus.
And I like the NAV bump there, Dominic.
Yeah, another one.
And when is that effective?
It's too bad it wasn't last year.
Yes. But investors have how many closings to get in before that NAV bump is realized?
Well, in terms of closing, we just issued out the OM, and so right now the offering is actually for 10 million. So the whole 10 million would be at $9. So once that gets capped out, then it'll increase from there.
Okay.
Limited time offer.
Good.
Excellent. All right. Well, thank you so much, Dominic, and thank you everyone for joining us this evening. So we'll get to the very important part where we thank you all for joining us, and I'll drink all the wine. No, just kidding. No, but thank you all for joining. Thank you to our guests, Dominic and Dennis, and Danny and Julianne. Always a pleasure to be around industry professionals that have been doing this for quite some time. So now we have everyone's names loaded up in our wheel here. So we have three wine boxes on raffle ready to go. I'll ship those out later this week, and I just got to remember which here it is. There is the wheel. So so it's completely randomized. I don't control this, just so we're clear. Some people thought, maybe we just picked names out of a hat, but no, actually, randomizers are more fun. This way, there's no no collusion, no corruption involved. All right, so our first winner. Oh, there we go. All right, so let me take a note of that. I had a pen here a second ago. All right, perfect. Let me just remove that name from the list. 2 to go, so you're upping your chances now.
Exactly.
I know Mike.
Oh, Mike G.
Yeah, I think.
Mike Gill. Right. Way to go, Mike.
All right. Last but not least, here we go. All right, Sabad. Excellent. Well, congratulations to our 3 guests who joined us and stuck it out till the very end. Sometimes we try to make these as entertaining and fun as possible, but also worthwhile, because at the end of the day, we do share a lot of valuable information with everyone here that can help you basically improve your portfolio overall. Because at the end of the day, we're not printing money on trees, so we try and find alternative ways of printing that money for you. So that being said, thank you everyone for the evening. I will let you all go and continue on with what you were doing. Maybe pour yourselves a glass of wine.
Exactly.
Thank you, everyone. Have yourselves a great evening.
Thank you, gentlemen. Thank you, Julie. Thank you, everyone. Have a good night.